Massive amounts of AI spending dominating the industrial space, but are we beginning to see other themes emerging for the sector? Joining us now to discuss is Juliana Fairclough, VP and Director for Portfolio Research with TD Asset Management. Great to have you back on the show.
Thank you for having me. Nice to see you.
Nice to see you too. This has been an age where we've been dominated by AI headlines. It is also true in terms of the amount of money it's raising, and perhaps some of the money is taking away from other spaces. Talk to me about what's been happening in the industrial space beneath the surface of all this.
Well, it's no secret that the AI CapEx trend has really dominated for the last, I would say, 18 to 24 months. We've seen that play out through really strong performance within industrials in electrical equipment, power equipment, grid infrastructure, cooling. But I think this paints sort of a misleading picture of what's really going on in the industrial economy. So while the AI CapEx has been very strong, catching a lot of headlines, catching a lot of investment, the rest of the industrial economy, we'll say, has been struggling with a few different things. So they've been struggling with deferred CapEx. So all of this political uncertainty, tariff uncertainty has kept a lot of companies on the sidelines from really investing. They've been dealing with an inventory overhang that's needed to be digested. So lots of orders throughout the pandemic eventually shipped, built up too much inventory. That all needed to be worked through the system. And they've also been dealing with just generally cautious customer behavior. So you've really actually seen quite a bifurcation within the industrial market. I brought a chart that I think helps show that quite nicely. So this chart, you'll see the blue line is the S&P 500 electrical equipment sub-index. Performance over the last 2 years, really strong. So companies in there like Eaton, GE Vernova, lots of familiar names. And comparing this here with the S&P 500 Transportation Index, so rails, trucking, sort of meant to reflect that kind of general industrial spend type of index. So you'll see quite a divergence here over the last 18 to 24 months within industrials.
All right, so that green line, transportation, a little starved of attention, maybe a little starved of investment as well as all the money goes towards AI. What's the setup then for 2026?
So I think AI is not a theme that is going to be stopped this year. We know the hyperscalers are going to spend something like $600 billion in CapEx this year. But I think if we look at the rest of the industrial economy, sort of breaking out that AI piece, there's sort of a micro and macro story going on. So from a macro perspective, we have rate cuts, we have tax cuts from the OBBA, tariff rates have probably peaked. So generally pretty supportive of a more cyclical recovery and backdrop. And even in the handful of trading days we've had so far this year, we've seen some strong performance of what we think of traditionally as cyclicals. So industrials as a sector as a whole, but also consumer discretionary materials. But then from a more like sector specific micro perspective, we are seeing some interesting setup for a broader industrial recovery. So generally, the fleet age of machinery is very, very old. If you think trucks, airplanes, tractors, all of these pieces of equipment kind of started off as being delayed CapEx in COVID. That has sort of compounded over the last 5 or 6 years into a structurally old fleet. You're also being bottlenecked by maintenance backlogs. So all of these old pieces of equipment need a lot more servicing, they need a lot more repair. That's now becoming a backlog that's impacting productivity for manufacturers. And then lastly, what I think is emerging as an interesting trend is just a push towards productivity. The labor market's quite tight. The manufacturing labor market is quite tight. And so that's pushing companies to consider investing in things like automation and new machinery to help improve the productivity of their output. So that sort of micro and macro together is an interesting setup for a broader industrial CapEx outlook for 2026.
So if we do start getting that broader CapEx spending across the industrial space, what parts of the industrial economy stand to benefit?
There's a few. I think a few to highlight, which might be interesting, would be mining equipment, industrial automation, and maybe transportation, as we've kind of highlighted it here already. So to start with mining equipment, I think you're dealing with a combination here of an elevated fleet age, as we've talked about, but also a very strong commodity and end market backdrop. So companies in the mining equipment space have been highlighting structurally older mining equipment fleets. So a company like Sandvik has said they're seeing the oldest fleet they've seen in the last several decades, so certainly ripe for a replacement cycle. At the same time, as I think we all know, and the audience is well aware, commodities have been really strong. So the backdrop for investment for mining companies is pretty interesting. I think the level of visibility of demand for some of the commodities like copper from electrification creates a more comfortable environment for mining companies to consider reinvesting and deploying a little bit of capex. So you've started to see orders inflect a little bit in these areas at companies like Caterpillar or Toromont and Finning in Canada, and some of the European players as well.
Got some of the miners, other spaces. You got a few more for us?
I do.
Yeah.
So industrial automation, I think, is another sort of interesting pocket to think about. Again, we're thinking here about a bit of an end market recovery, as well as this push towards productivity and sort of automation. So from an end market perspective, automation and robotics generally tied to sort of broad industrial production and manufacturing. Autos are a particularly significant end market, at least today, for automation. If you or any of the viewers have been and toured through some of those auto plants, there's a lot of painting robots and a lot of mechanical arms, all of which have been pretty depressed with auto production being quite weak over the last couple of years. So as we start to see some end market recovery tied with a push towards reinvesting in automation across manufacturing plants, helping to enhance the productivity of the limited existing labor within the manufacturing economy, it sets up nicely for industrial automation companies. So some of the large European conglomerates have a lot of exposure there, like a Siemens or ABB or Schneider, have seen some bottoming in their industrial automation businesses.
So that's mining and that's industrial automation. Was there a third one?
There was a third,
one?
Transportation. We've been in a pretty difficult freight recession for the last 3 years. It's something I think you and I have talked about a few times. It's been a tough environment for rails, and it's been a tough environment for the trucking companies. As we start to see that broad sort of industrial muscle start to move a little bit more positively throughout the economy, it's definitely a good setup for the rails, which we can think of as kind of the veins of the industrial system, really moving everything from point A to point B. So we've already seen that in truck rates starting to tighten up, and it sets up for perhaps the end of this quite prolonged freight recession that the rails and transports have been dealing with.
The word perhaps suggests to me there might be some risks there. What other risks?
Absolutely. So there's always risks. I think the first and probably largest risk is just political and geopolitical uncertainty. We're still operating in quite a volatile time from a policy perspective and from a geopolitical perspective, and that can be quite impinging on companies' confidence and willingness to invest and put capital behind some of their decisions and behind their business. I think a general economic slowdown would obviously be negative for some of these more cyclical and cyclically driven sectors. And then lastly, AI is a very hungry machine, and that could continue to sort of crowd out some investment in more traditional or broader industrial spending as we continue to fuel that AI fire.